If you're anything like me, you've probably been watching the telly and laughing, literally laughing at the craziness out there in the global market over the last couple of months. In this video today, I wanted to address the elephant in the room and talk about what's coming next, where we are in the current economic cycle, the business cycle, the real estate cycle, in terms of the big picture. And I'm going to talk about the mid-cycle slowdown event that I've been talking about on camera now for a couple of years, and it looks like we've finally found ourselves in it. For those of you who haven't already checked this stuff out, your first book and your homework today is to check out Fred Harrison's The Power in the Land. Now, this book was published, I think, in 1983 and predicted the 1990 recession that we had to have. Now, Fred Harrison also published a second book, which is in my bookcase just here behind the camera, called The Power in the Land, published in 2005, calling the 2007 global financial crisis. Now, what this book does, The Power in the Land, is it looks at over 250 years of booms and busts in the UK property and stock markets, and gives you a bit of an understanding about the bigger picture, the reason these events consistently come up, and also a bit of peace of bloody mind so that you know that the world isn't ending. We're not falling off a cliff right now. We're not all going to die from the coronavirus, and that there is a light at the end of the tunnel if you have a longer term vision. Now, the second book, which is very well used here, you can see about 50 coffee mark stains in this one from me, or tea stains, because I don't even drink coffee. I don't know why I said coffee. It's The Secret Life of Real Estate and Banking. Now, this one's a bit hard to find online and it's a bit expensive, but it has changed my life, and I can guarantee if you read the last chapter alone, you will think about things so differently, you will sleep differently, and I think your returns over the long term will be exponentially higher. Now, in this book, Phil Anderson wrote, which was released, I think, in 2007 or 2008, was the first person globally to predict the correction from the global financial crisis bottom. He also had a subscription service where he was talking about what was coming absolutely years in advance. This book looks at 250 years of American booms and busts and is absolutely vital. Now, the reason it's vital, I've got a couple of notes here, is because that for the last 60 years or the last 3 cycles, Australia has very, very closely followed both the American and the UK markets. Now, what we find, and I'll talk about this in a lot more detail on the board in a moment, is during this mid-cycle slowdown point, we generally see a correction in the stock market, a correction in the world economy in terms of the business community, and either one of two things happening from a property price perspective. Things going flat for a period of time. Sometimes in some areas that haven't seen strong growth in the first half of the cycle, prices keep moving forward. Sometimes we see a small pullback in property prices, generally in the tune of maybe 10% worst case scenario. But unfortunately, just during this mid-cycle slowdown point, as you've seen recently, stock markets can get an absolute beating and drop by as much as 40%. So for those of you out there, talk to your financial advisors, accountants, or follow the best and brightest online. Try and figure out your position and manage your downside, but also know that long term, the market looks like this, but in terms of the journey, it's like this. So if you're a long-term investor, absolutely nothing to freak out about. If you're trying to get rich this year or next year, maybe you've learned a heavy lesson. I've done videos about this before, about the 18.5-year real estate cycle, but I'm going to sort of talk it through again, mainly around the mid-cycle slowdown point. So generally what happens is we have a bottom of a marketplace. Now, the last one you might remember the name of, it was called the Global Financial Crisis. Another one that you would have heard of was the Great Depression. Now, this is an environment where effectively we've absolutely gone ballistic. Think about when cryptocurrency went from nothing to $26,000 and then back to $3,000. This is the bottom. This is when there's blood on the streets. A lot of the banks have failed, governments have failed around the world, people need to be bailed out, there's bank foreclosures, people are really freaking out, and it's an economic environment that completely wipes the system back to scratch, and then we start again. Now, what happens is we generally have somewhere between 6 and 8 years of growth off the back of that. Now, the reason we get this growth is because the system has reset, assets are actually priced as they should be, and then what happens here is governments and central banks around the world intervene. They start giving everybody easy money. They start reducing interest rates. They start pumping money into infrastructure. They give business subsidies, and all of a sudden, that cheap money floats the stock market and property markets around the world to a point where they're unsustainable, which was very early at the start of this year, 2020, where almost every environment around the world reached all-time highs. And then what we get is this mid-cycle slowdown point. Now, this is where I'm going to really focus my attention today, but I will come back to that. And then what happens is we get a second half of a real estate cycle. Again, like I said, generally here we're talking about 6 to 8 years. Here we're normally talking about 1 to 2 years. Here we're generally talking about another 4 to 8 years up. Generally, actually it's probably more like 4 to 6 based on Phil Anderson's work. And then what happens is we get to an all-time high globally and we see a major decline. Now, this is a dangerous place, particularly the last couple of years, to be investing, where the risk doesn't make the reward. Then what happens is we get back to a bottom again and the whole cycle repeats itself. Now, according to Phil Anderson's work, this cycle's been repeating itself with somewhere between about a 17-year to a 23-year average for the last 250 years in America. According to Fred Harrison, this cycle's been repeating itself for over 300 years in Europe. Despite all the technological advances, the advances in our economic modeling and systems and the way that we do things, this is a cycle. Now, this cycle should actually be called the human greed cycle, and that is people wanting to make short-term money at certain stages of the cycle where they pay too much. Now, if we want to put some points around these sorts of things before I talk about this mid-cycle slowdown point, the bottom was somewhere around about 2011 to 2012. We got a 6 to 8 years up to the top of 2019. We'll get a decline or a going sideways for a couple of years, somewhere around about the 2020 to 21. And then, according to Phil Anderson and Fred Harrison, we get the next top somewhere between 2025 to 2026. Now, these are important dates to put in your calendar and to lock into your mind. But obviously, these things don't always happen perfectly. Like, no one knew that the coronavirus was going to be the catalyst for people to freak the hell out, for markets to freak out, and for people to retreat or to start taking losses in the stock market. And I think we'll begin to see an effect on global property prices as well as a result of this, mainly as a result of people moving away from markets. Obviously, some people's businesses are getting affected, some people's jobs will be affected. So this mid-cycle slowdown point is important, and then what happens after this as we move through the next stage of the cycle. Now, if we look at what's traditionally happened in Australia, which is extremely important, what happens is Sydney and Melbourne generally do extremely well in the first half of the cycle. In fact, in the first half of this cycle, they've got to a point where it feels like they're pretty much unaffordable for the average Australian to be in those cities anymore. What generally happens is we go through this correction phase. Now, we might have actually done this already in Australia with property prices declining by 10 to 15% in 2018, 2019, but obviously for some reason, Sydney and Melbourne have gone crazy again, and I think that reason's the same reason that people are fighting over toilet paper right now, and that's because they have FOMO and they're emotionally buying, they're not actually logically buying. Now, what we generally see in this second half of the cycle is regional marketplaces around the world, or the second tier cities, seem to do much, much better. Now, as you know, I grew up in Sydney, but I'm now really focusing on Brisbane. Once I get to a top in Brisbane, I then plan to go back to Sydney and Melbourne and buy the bottom. Now, some of you are thinking that Sydney and Melbourne are never going to be on sale again. You're never going to be able to enter those markets. Take that idea away from your brain. I can guarantee in the next GFC, I'll be buying some parts of Sydney on the northern and southern beaches for 50, 60 cents in the dollar compared to today's prices. Now, that's not meant to scare anyone. That's meant to educate you and get you excited. You might not buy them on realestate.com, but if you know the right people in the banks, the public trustee, as well as the solicitors selling these distressed properties, there is going to be some bargains available sometime down the future. But for right now, Sydney and Melbourne have gone crazy, where places like Perth, for example, is apparently, according to CoreLogic, cheaper than it was 14 years ago. Brisbane is cheaper to buy now than it was 12 and a half years ago. These places that haven't done well in the first half of the cycle, according to Catherine Cashmore, Phil Anderson, Fred Harrison, generally do a hell of a lot better in the second half. And that's why I'm going personally into Brisbane, not just because it's affordable, not just because it's done nothing recently, but because the cash flow is strong. And what you want at the top of the market is strong cash flow, so that when everyone else is freaking out, losing their jobs and their businesses are closing, you've got consistent cash flow to be able to take advantage of the next stage of the cycle. Now, Catherine Cashmore did some interesting analysis of the first half and second halves of the cycle, and she found that in the UK, in the second half of the cycle, after we get through the mid-cycle slowdown point, regional England did twice as well as London. Now, I've done some research over the last 60 years, year by year, and what I've found that on average between here and here, Brisbane's worst result in the last 3 cycles has been 85% growth. And in fact, in some of the cycles, it's done over 120% growth before we hit the next top. Now, I don't know if that's going to happen again or not, but for me, it gives me confidence to know that at least I'm buying at the bottom of Brisbane and I've got an opportunity to keep moving forward. Now, there's reasons why the second half of the cycle is generally stronger in terms of asset gains than the first half, according to Catherine Cashmore. Now, one of them is that the severity of the last GFC or Great Depression is almost forgotten by the time we get up to here. Everyone's freaking out right now about where we are, but the reality is this will feel like a blip in the radar by the time we get to here, and you'll see what I mean over the next 7 years. Now, what happens here, and you've already started to see it in Australia in 2019, is that the banks really tighten stuff up here to protect everybody. They get really tight on money here, and then they start loosening up. Now, if anybody's seen, APRA has basically taken the reins off the Australian property industry and the banks, and they're now becoming loose with money. That loose money, as well as lower interest rates environments, obviously turns into rampant speculation, particularly towards the second half of the second part of the cycle. Now, regional areas and secondary cities normally do better because the bigger cities normally capture the lion's share in the first half. And what also happens is that buyers that are priced out of the inner city markets start to go to the outer markets in these big cities as well, and therefore that growth starts to ripple through. And we've already seen a bit of that in Sydney and Melbourne, but not too much of that anywhere else in Australia in this first half. So it's an exciting time to be an investor. Now, in terms of what you need to understand about this is that if you're because caution is always needed, even if you understand this cycle, because it just takes something to change for this cycle to not be a theory that works anymore. And there has been times in history where it hasn't worked perfectly, or the time frame's been shorter or much longer. So you don't invest in this time if you don't have stability in your job or your business. You don't invest in this time if you don't have, excess income, meaning more savings than spending each week. You don't invest in this time unless you have a cash buffer in place to protect yourself. You don't invest in this time if you have insecurity about your current role or your industry is being heavily affected at the moment. But this is a beautiful time to invest if you have strong savings, if you've got a good income, or if you've got good combined income, if you've generated equity in your home over the first half of the cycle, if you've used this first half of the cycle because you're freaking out after the last GFC to just squirrel your money away and pay down debt, if you're saving a lot more money each week than you're spending, if you've got good savings or equity in the bank, that is a incredible once in a 10-year buying opportunity. Now, I've been saying this for years and years and years. Now, I want to explain what I've done to trade this cycle so that you can understand my mindset, and I want to show you what I'm going to do as we move through this cycle. Now, I want to explain exactly what I've done over the first half of the cycle and what I plan to do through this mid-cycle slowdown point, as well as for the second half of the cycle to prepare for the next GFC, which is a once-in-a-lifetime buying opportunity for the right people. So, over this first half of the cycle between 2011 going through to 2019, I bought personally 12 properties. Now, in 2016, I started to sell my first properties out of Sydney because I knew that we're at the top of the marketplace. So at that point, I started to exit out. And between 2016 and 2019, I literally sold 8 of those properties. Now, what I was doing there was 2 things. One, I've obviously learned a hell of a lot since I first started, so I was getting rid of properties that no longer make sense for a 40-year plan for me or my family. But what I was also doing was cashing out from the gains from the first half of the cycle, putting money into cash, putting money into investments that produce cash flow for me, paying off big debt in my life, and getting myself prepared for this moment, because what I know is I've got 2 years here while people are running around fighting each other in the streets to buy fucking toilet paper and freaking out about the media and freaking out about a virus and freaking out about the bumpiness in the stock market and whatever else like people follow on TV about this stuff. And I don't mean to be cynical here, but I just want to shake the camera like, man, people are doing some dumb shit. And you don't have to be one of those people. And then what I plan to do here is in 2020, I plan on buying 2 more houses. In 2021, I plan on buying another 2 houses and granny flats. So I'll again have another very, very strong property portfolio. I use this buying window when everyone else is focusing over here to do something smart here. And then basically, I won't do much buying between here and here at all. I'll just have the high quality property portfolio. I'll ride the wave up. I'll use this 4 to 6 years to pay off as much debt as I possibly can as quickly as I can. I'll get myself in the best possible cash flow position here, hopefully owning as many properties as I can completely outright. I'll wait for the marketplace to dip, because all of the properties that I'm buying now are not just bought at the right time, but have great long-term potential for growth, being a metro market like a Brisbane for now, Sydney, Melbourne in the future, as well as incredible cash flow. So that's why I'm doing the house and the granny flat or the dual income properties, so that, you know, instead of having to buy 12 properties, I can own 6 and get the same cash flow from all those granny flats. I then, at this point, which is effectively the top of the cycle, refinance, release as much equity as I possibly can, improve my cash position as much as I can. I wait for this slide, which is generally about 2 years from top to bottom, and then I start buying again. Now, what is important to know about this phase is that Sydney and Melbourne in the last 3 cycles have done no less than 100% growth in the first half of the cycle. Now, imagine you knew this, right? Imagine you had bought a bunch of properties in Sydney and Melbourne, sold half of them here for 100% profit, paid off the other half outright. You loaded up on a couple of smart properties in Brisbane here. You held those properties to here. Because the cash flow is so good, you'll just hold those properties forever. Then you get yourself into a great cash flow equity position here. You wait for the entire world to think that nothing's going to be good again and everybody's freaking out, and all of those people were holding off to sell finally sell. And then you buy Sydney and Melbourne again here, knowing that the chances in the next 7 years of strong growth of between 30% and 100% are almost guaranteed from 100 years worth of data. Like, can you understand from this model how you can time the Australian market and play around with the cycle? Now, Perth's another market that's expected to do well in this second half. Other parts of regional Australia might do okay, but as you know, I don't buy regional because of the long-term capital growth difference between the metro and the regional. But this is Interesting where we are right now. A lot of people are going to freak out. They're comparing it to the GFC. You know, there's going to be a lot of negative news over the next year and a half about this. There's going to be a lot of people, in fact, 8 to 9 out of every 10 of you are just going to sit on the sidelines and wait this through. You know, keep watching Sunrise and A Current Affair and all of the rubbish out there about this stuff that's fear-mongering, and smart investors like myself, like my clients, and like you are going to take advantage of this time. Now, I'm not saying that with Sydney being 60 to 100% more expensive now on average, or Melbourne, that now's a good time to buy Sydney for a bit of a dip. Absolutely not. It's already had its growth priced in. It might do well in the second half of the cycle, but man, if it does, it's going to cop a big belting at the end of all of this. But places like Brisbane and Perth that are cheaper than they were before the last dip look very, very, very interesting to me. 25% of the population, job and income growth going into southeast Queensland versus 8% in Perth. That's why I'm more bullish on Brisbane right now, but Perth might get some speculation. I think in the last half of the second cycle, I think Brisbane did 85% and Perth did something like, I'm not even joking, like 130%. So interesting times. Don't freak out, get educated. Love you guys to share this with other people who need to see this stuff. All through this year and next year, as well as the last 5 years, I'm trying to share different ideas. Check out Phil's book, check out Fred's book. You know, understand that this isn't the end of the world, but stocks might take a bit of a beating, certain businesses might take a beating, unemployment rates might rise. The things that the government's doing right now, and this is important to note, that are going to mean that things get a lot more expensive in terms of the global stock markets and property markets over the next 7 years, is firstly, they're reducing interest rates. They're 100% going to reduce them again this year, taking them down to 0.25% in Australia. We'll be seeing interest-only loans for under 3% for homeowners and investors in the 2s by 2021, maybe even the end of 2020. They're reducing interest rates, which means that once people's confidence comes back, and the only thing stopping this happening right now is confidence. People always freak out about this right here. Once the confidence back in the market, you watch those cheap interest rates turn into artificially inflated asset prices, which is why there's a bigger decline at the top. The other things the government's doing is they're about to start printing money, which is called quantitative easing. It is deadly if you've been holding cash throughout that period of time, because the value of your money in the bank over the next few years is going to decline while the value of assets longer term is going to grow. That's why I'm moving my money, which I've had in cash, into assets again now. The other thing that they're doing is helicopter money. So they're planning on dropping money out to businesses and individuals to kickstart the economy. They're also doing infrastructure spending at the moment. The tax breaks coming if the Liberal government stays in between here and here are insane. Like, think about you if you're earning more than 180 grand a year right now through your business or your job. You're literally paying 45 to 50 cents in a dollar. If the Liberal government stays in, they're saying that by about 2022, the tax rate for people earning 180 grand a year will be 30 cents in the dollar. Now imagine you literally got to keep 1 out of every 4 extra dollars than you currently do right now. This is why asset prices can go higher. Now, all around the world, the governments are doing the same things to try and get us out of it. Obviously, people didn't see the coronavirus coming, but it was the time for these markets to start doing this. Now, I've been talking about it online for 2 years. Every single week for 2 years, Phil Anderson's been emailing me, telling me exactly what's coming next. It's just not that difficult if you understand it. Like, imagine you'd done what I'd done, loaded up on some properties, sold 8 of them, and was ready for this opportunity where everybody else is looking there and you can just go there. You know, it's not normal to buy when other people are freaking out. It's normal at this time to think that the whole world's going to collapse on your head, but based on history, I can't predict the future, neither can Phil Anderson, Fred Harrison, Ray Dalio, or Warren Buffett, but you can trade the cycle better. Now, in 2019, I went to an event with Phil Anderson and his number 2, and they talked about the fact that they'd completely pulled out of the stock markets because they knew that in 2020, or late 19, there was going to be the start of a decline, and a pretty major decline in stock prices around the world. Imagine I told my parents to pull out of the stock market based on that information from them. Now, I'm not a trader, but they both said to me that the downside risk was not worth the extra 10% they might have got between December and January this year. So, you know, imagine you went into cash. Instead of the 20% decline that everybody's just experienced on their super, you didn't. Then you bought at the bottom again when, you know, the stock market's 15 to 30% below the top. And then you got the rebound off the back of that as well. Like, if you can manage your downside risk during these times, you can completely transform your life. Although nobody can time the markets, not even the best of the best. So obviously there's a lot of thought process around, well, just buying and holding forever is better than trying to buy in and out of marketplaces. But you know, the most successful investors of all time understand these things. They understand when to go into cash. They understand when to leverage up. They understand when to have great cash flow and equity to buy again. And now you do as well. So I wish you all the best. If you're serious about figuring out what the hype is this year versus what the truth is, about building a really, really clear property investment plan, getting the confidence that you need to make really smart decisions for the next 15 years for you and your family, I'd love to offer you a one-on-one strategy session. Please jump over to www.pumpedonproperty.com, click in free strategy session. You know, if you're a person that's freaking out right now that doesn't have cash or equity, these sessions are not for you this year. These sessions are for people who have been sitting on the sidelines with good cash, good savings, good incomes, that have been waiting for this type of environment, like myself, to take advantage of it. They've been waiting for Brisbane to bottom out. They've been waiting for the sentiment to go the other way and everyone to freak out for no reason. They have the confidence that their strategy is long-term, that they're not going to freak out if prices go up or sideways or backwards over the next 2 years, which any of those things could happen, that want to get really strong long-term buying opportunity for growth as well as strong cash flow, then come and have a session with myself. I cannot wait to talk to you. I can't wait to share the other 1,000 things that we're talking about internally with our clients at the moment that we can't talk about online. It's just an exciting year, one that I've been waiting for personally for 3 or 4 years now, and it's that time in the marketplace to do the opposite of what others are doing. Again, I'm not saying go buy Sydney and Melbourne that are already crazy overpriced. I'm not saying to rush in and buy stocks because I don't know anything about it. I don't know if it's going to bottom or if it's bottomed or if it's going to go further. I'm talking about well-located property close to the city and the beach in Brisbane with incredible cash flow. That's what we're specializing in. That's what I'm trying to do. So I wish you all the best. Stay safe. Please share this with someone that needs to see it. I'm going to be doing heaps of cool content this year with as much information as I can to educate you, to slowly help you build confidence. You know, the loudest voice in the room at the moment is the media, freaking you out about, you know, you or your children dying from a virus, or freaking you out about a recession coming, which I think there's going to be a recession this year, but a recession is just a couple of quarters or a quarter of backwards growth. It's not that big a deal. The government's pulling all the levers to get us through this thing, and governments around the world are trying to do the same thing. You know, I have confidence that longer term, the cycle is going to continue to repeat. There's going to be ups and there's going to be downs. There's going to be bumps and bruises. You're going to lose some money. You're going to make some money, but over the long term, you can do extremely well, and I want that for you, and I want you to have the confidence, whether it's with us, on your own, or with someone else, to do something smart and start setting yourselves up. Because you wait another couple of years or you wait another 5 years, then there's all sorts of stuff coming after that that you'll see over time as we go through this thing. So I wish you all the best. Please stay safe. Please subscribe to the channel. See you later.